Hello and welcome to our latest investment strategy update. So far, 2019 has been a tale of two trends: declining trade and rising equity markets. Trade flows collapsed last December, threatening growth and business confidence as US tariffs disrupted supply chains. A recession in global trade has had a huge impact on open economies such as China, Japan, the European Union, and obviously Switzerland. The Eurozone's weakness is linked to trade uncertainties, while its domestic demand dynamics remain sound. A worsening momentum and growing global uncertainty led the ECB and all other major central banks to pause their monetary normalization, and key interest rates are on hold for most of 2019. However, if trade improves, the regions that have suffered most should be the ones to recover first. And trade remains largely dependent on the evolution of Brexit and negotiations between the US and China. The impact of tariffs has improved outlook for a deal, and there's even a possibility that some of the imposed tariffs could be removed. Meanwhile, we expect Chinese activity to slow somewhat this year as the economic model evolves. Authorities continue to support growth throughout a moderate fiscal stimulus, and with low inflation, there's still room of maneuver with monetary measures. And let us not forget that Brexit is first and foremost about trade. The outlook for the UK economy will be determined by upcoming negotiations. Overall, even if global growth is slowing, the macro context is supportive. We expect a gradual recovery in trade and the gap in economic performance between the US and the rest of the world to narrow. How does this shape our investment strategy? Well, let's hear our latest views from Stéphane.
As Samy just mentioned, global equities have rallied this year, with markets pricing in the shift in stance by the Fed and more recently by the ECB. Expectations that a pause in monetary policy normalization will compensate for the drop in trade are rising. Hopes for a US-China trade deal and Brexit have also contributed to the positive sentiment. While we share some of the optimism for risk assets, we also see reason for caution as much seems priced in. Investors now need to strike a prudent balance between risk and reward and be mindful of market volatility. We have applied two layers of defense in our portfolios. First, since June 2018, we have been reducing exposure to risk assets to levels consistent with late cycle dynamics. And secondly, we have implemented long put options on stock indices to shelter gains and shield portfolio against downturns. Based on accommodative monetary policies, we are also seizing opportunities in carry strategies by reinvesting some cash into short-term fixed income. We have shifted our emerging market exposure from equities to debt in local currencies, favoring Russia and Brazil. In currencies, the ECB's new forward guidance is a game changer for the euro. We have revised our year-end forecast for the euro down from 120 to 114 and close our position on the pair. While the central bank's accommodative approach continues to keep rates stable and support risk assets, there is significant geopolitical uncertainty ahead. We will keep a close watch on the US-China trade talks. If a deal is reached and trade improves, China and the EU should be the main beneficiaries. Also Brexit and how the extension of Article 50 affects sterling and risk appetite. Finally, the European parliamentary election in May. Uncertainty can take many forms, but global trade is currently overshadowing all else and affecting the outlook for financial markets. The geopolitical risk I just mentioned will determine whether trade flows pick up, which will then result in an improved growth and a supportive context for risk assets. As we head into the second quarter of the year, we continue to advocate for prudent optimism and resilience in portfolios. We will keep you informed on how the upcoming developments shape our macro outlook and investment strategy. Thank you very much for watching.